Welcome back to Project Pulse. Up to now, we have built a full cash flow bridge all the way down to free cash flow to equity. And once we have equity cash flows, we can finally calculate the key equity return KPIs investors care about: levered equity IRR, NPV, cash on cash multiple, and payback period. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build the model alongside me. Link is in the video description below. Before we move to the modeling part, let's first cover some finance basics. IRR, or internal rate of return, is the discount rate that makes the net present value of cash flows equal to 0. Conceptually, IRR is the project's annualized return to equity, based on the timing and magnitude of the equity cash flows, the initial equity contribution, and all future equity distributions. In practice, we don't solve this manually. We use Microsoft Excel's XIRR function, which is designed for cash flows that happen on real dates. And all we need is 2 inputs, the free cash flow to equity and the timeline dates. Interpretation is straightforward. If the IRR is above the equity hurdle rate, the project clears the return requirement. If it's below, it doesn't. Now let's jump into Excel and implement the IRR. Alright guys, welcome back to the model checkpoint file from our previous lesson. And in this lesson, we will wrap up our equity section by calculating our return KPIs down here. And now that we know what the IRR stands for, let's actually implement it in G693, which will then also ultimately feed into our top section of the model right here, so that we always have the impact of changes to the model right inside at the top of our model headline here. So to calculate the levered equity IRR, all we need is to implement the XIRR function. And the XIRR function over the regular IRR function gives a little more flexibility when considering different dates. So I recommend to always by default use the XIRR function over the IRR function. The first thing we'll have to implement are our values. And that is going to equal to K690. So here we pick up our net free cash flow to equity. And it's important that for the XIRR as well as the XNPV function later, our initial value needs to be negative because that is a cash outflow. And the IRR function only works if it's considering first some cash outflows. That can also be multiple cash outflows. And then later on cash inflows. That's why we pick up our net free cash flow to equity line. So mark this whole row up to AT690, comma, and for our dates, it's important that we use our end of period dates. Oops. So make sure that you pick up the end of period dates, because this is when we assume the cash outflows and the inflows actually to occur. And since it's a yearly model, we always pick up the end of year value. So mark all of these cells. We don't need an input for our guess. So just close parentheses, hit enter. And for case 2, which is our full tolling case and our equity base case, you can see that we get an equity IRR of 13.75%, which, let's scroll down all the way to the financing and equity section, is above our target minimum equity IRR of 10%. So our equity investor expects a minimum equity IRR of 10%. And this value here, the minimum equity target IRR, is going to be particularly important for calculating our NPV. So for case 2, we definitely hurdle from an IRR perspective. And now let's move on to the NPV. NPV, or net present value, is the present value of all future equity cash flows minus the initial equity investment, discounted at the required return. So NPV answers a different question than IRR. Not what's the return, but how much value are we creating in today's dollars if equity requires a return of, say, 10%. Mechanically, we discount each equity cash flow back to today using the equity hurdle rate, and then we sum them up. Positive NPV means that we are creating value above the required return, and negative NPV means that we are destroying value versus that hurdle. In project finance, NPV is helpful for comparing scenarios and structures, because it converts everything into a single value metric at the investor's minimum return. Now let's move back to Excel and implement the NPV. Alright, now let's move on to calculating our NPV. And that is going to be a very similar approach. We will use the XNPV function, which works very similar to our levered equity IRR calculation or XIRR function, except that this time we do need a rate, and that is our minimum equity IRR, which we pull in from our inputs time independent sheet here in cell G696. So pick up that rate, comma. For our values, we will have the same time series from our negative free cash flow to equity up to the very last period, year 2060. And then we will pick up the corresponding dates. Move that over, close parentheses. And before we hit enter, we do expect a positive value for this formula. Why is that? Because we know that our levered equity IRR is above our hurdle. So if our actual IRR is at 13.7%, that is 3.75% above our 10% minimum target, which means that our NPV must be positive. And the NPV helps to then put a figure on how much value we are actually creating in today's dollar terms, because we use a present value, time value of money approach. So hit enter, and our NPV is $14.1 million, which essentially means that after considering the time value of money effect, we create $14.1 million in today's dollar terms. Now let's flip that over to our fully merchant case, case 11, and see how our return metrics shakes out then. Hit the master macro, and you will see that here in case 11, we are actually well below our minimum target at a levered equity IRR of 4.5%, which translates into an NPV of negative $59 million. So from today's perspective, we're pretty much destroying $59 million if we assume that our equity investor would require a minimum return of 10%. Then let's move back to case 2, which is our more profitable case. Hit the master macro for our debt section. And the NPV is an output on a time value of money basis, and the next output does not consider any time value of money effects, which is our cash on cash yield. And in this cell, we will calculate our 30-year cash on cash multiple, which is one of the simplest return metrics. It's basically just a total cash return to equity divided by total equity invested. So what we do is pretty much just pick up our total equity dividends. This is how much money we get out, and we divide by our initial investment, which are our equity contributions. So just pick up the two sum totals in column J, hit enter, and we get 448%, which pretty much means that for every dollar we invest, we get $4.48 back over a period of 30 years. So this is a pretty intuitive figure without considering any time value of money effects, and it helps to see the overall key returns more holistically, having some return metrics considering time value of money effects and others that don't. And this is our cash on cash multiple over the full asset life. In our case, here we consider 30 years of model timeline, but actually our asset life is only 20 years. So that pretty much just reflects what we get over a period of 20 years. Then we can also calculate how much cash on cash we get in each period. And that pretty much only equals our equity dividend divided by our initial investment in J689. Hit F4 once to fully anchor it. Then we can drag it over, Control R. And you can see that our cash on cash yield initially is around 10% each year, between 10, 12, 13%. And then there's a significant jump in the end where you can see that most of our money actually comes back in the last 5 years. And that is because our term loan principal is fully repaid after year 2040. And that is the reason why we get little cash flow back in the first 15 years and then a significant cash flow in later years. Because in the first 15 years, we have to mainly service our debt with all the cash flow that the SPV is generating. So if we have each period's cash on cash yield, we can also calculate the cumulative cash on cash, and that is equal to our previous period's total cumulative cash on cash. Let's put that in parentheses. And then we will add the current period's cash on cash yield, close parentheses, and we'll multiply this with our flags. So let's do the maximum of our operations and financial close flag. So our financial close flag is up here. And then we will also pick up our operations flag. Close this, hit enter, and let's drag this one over, Control R. So now you can see how long it takes to get $1 back. So in year 2034, we would get $1 back on each dollar invested. Oops. Then it takes another 1, 2, 3, 4, 5, 6 years pretty much for the second dollar to return. And then we get $1 for each couple of years thereafter pretty much. So that's for the cash on cash yield. And then we have one final KPI, which is our payback period. And payback period answers how many years does it take until equity gets its money back. And again, for this KPI, we do not consider the effect of time value of money, but instead we track our cumulative net free cash flow to equity over time and then see when it actually turns 0 or positive. So this is going to equal to our previous period's cumulative net free cash flow to equity. Let's actually put that in parentheses again, similar to our cash on cash yield. Plus, we will add our net free cash flow in the current period. So here, this one is going to be negative. And then again, we will multiply this with our two flags, our financial close flag, as well as our operations flag. So our financial close flag is up here, and then our ops flag in row 12, close parentheses, hit enter. Then we can drag it over, Control R. And you can see that initially the equity investor is money out, 36 million. And in year 2034, we see that the equity investor will have all the initial investment back because our cumulative net free cash flow to equity has turned positive. And we can automate this by calculating our payback period right here. And what we'll do is use a COUNTIF function. Type COUNTIF. And we'll pick up our cumulative net free cash flow to equity row, this entire row here. And we want to count, comma, if in quotation marks, the values therein are smaller, and 0. So the COUNTIF function works a little counterintuitive here. So what this essentially reads is that we only count the value if it's below 0. And to do that, we put that in quotation marks, the smaller sign, and then we need an and sign and 0, close parentheses, hit enter. And that returns us a value of 9 years, which gives us just a little more flexibility, especially for our scenarios output sheet, where we will be able to see the payback period for each of our 21 scenarios. And all the COUNTIF function does is count all the negative values right here. So you can see we have 9 periods of negative values. And then in year 2034, we finally turn positive, which translates into a payback period of 9 years. So in addition to our time value of money KPIs, which is our levered equity IRR, as well as our NPV, adding our cash on cash yield and payback period provides a more holistic view to our investment decision makers and allows them to compare conceptually 2 KPIs with time value of money considerations and 2 without. Now let's flip back over to our case 11 and see how long it takes to get our money back here. Hit the master macro. And what you will notice is that our NPV is negative, but we still earn more money than we put in. So the initial investment is $170 million and we get 266 million back, which basically means that for each dollar invested over a period of 20 years, we get $1.55 back. And we also get our initial investment back after 13 years, which we intuitively see with those 2 figures. But with just plainly looking at the NPV output, one might think that with this investment, we don't even get our initial investment back, but that's actually not the case once we consider our cash on cash yield and our payback period. All right, let's flip back over to case 2. And now that we have IRR, NPV, cash on cash, and payback period, we have actually completed our full operations sheet, which means that in the upcoming lessons, we can finally run through all 21 scenarios and see how these KPIs behave across different revenue stacks, risk cases, and structuring assumptions. All right, guys, this was it for this lesson, and I will see you in the next lesson. See you there.